According to Hall Chadwick's annual financial reporting update for 30th of June 2025. For those people who don't know me, my name is Michael Hillgrove and I'm a partner in the Audit and Assurance Division of the firm. Before commencing, I take a moment to respectfully acknowledge the past and present traditional owners of the land on which we stand, the Noongar Whadjuk people who are the custodians. Together, we acknowledge the contributions of Aboriginal Australians and non-Aboriginal Australians to the people on this country we all live in and share together, Australia. Hall Chadwick continues to grow, and we've recently welcomed on board 2 new directors, expanding our tax and business service team. Bryce Scadoni and Gerrit Vorster have joined, and they're actually here today. Gents, would you like to stand up just to... Bryce and Gerrit would love to catch up with you during our morning tea break, so please feel free to come up and introduce yourselves to them and hear the services that they can provide to you and other potential service areas that you have. It gives me great pleasure to introduce to you our speaker, Wayne Basford. Wayne is the Managing Director of Basford Consulting, has had over 25 years experience in audit. All right, so I'm not Kanye, and that was not meant to happen. And our blue tack has just had a little bit of problem, but we can continue on because that's the sort of people we are here at Hall Chadwick. Nothing puts us off. So Wayne is the Managing Director of Basford Consulting and has over 25 years experience in audit, advisory and accounting consulting. He has worked with major global accountancy firms over 3 continents and is a specialist on international financial reporting standards and corporate governance. Please welcome Wayne.
Okay, good morning. That resume is getting sadly out of date. I think I've been doing it since 1989. So I wish I'd only been doing it for 25 years. These are the areas that we'll go through today. And the good news, and everybody can now go home and wonder why they've got battled in the rain and the parking. The good news for June 25, there's not a lot happening. The reality, if I'm being my professionally skeptical self, as I should be, nobody's really on top of what happened in the last 7 years. We had this massive wave of AASB 15, AASB 9, AASB 16, and everybody's sitting there thinking, well, I've survived that wave. But you're still in the water. All those things that you didn't quite understand back in 17, 18, 19, you still don't understand. And it's not going away. We live in interesting times, and as a bigger background, remember our standards are driven by the international standards. They come out of London, they come out of the AASB, and sort of the good news for everybody, I think, the ISBs broke. So we got the IFRS Foundation. It was always the ISB. They did the International Accounting Standards Board. And then in the biggest land grab since the Louisiana land purchase, we accountants got into sustainability. Not that we accountants know much about sustainability, but we will actually lead sustainability reporting. And they established the International Sustainability Standards Board, the ISSB. And the ISSB has spent a load of money. The ISSB has set up offices in Toronto, set up offices in Tokyo, has been on business, because they're on the Sustainability Board, so they fly around business class, first class, whenever you look at Sue Lloyd, she's always on a plane, always glad that she's her. I'd love to see their carbon footprint of the ISB. But in reality, back to pure economics, they've spent all the money. And at the moment, in both boards, both offices, they're retrenching people. So they actually haven't got the staff and resources to write any new standards for us. So we're going through a very quiet consolidation period with, and we'll come to it, and a lot of these things will be rhetorical questions as we go through it. Has everybody read IFRS 18? Is everybody ready and excited for IFRS 18? Because it's out, it's been out for 2 years, and it's a major change. So the major thing that in my next 5-year horizon, the only thing new I have to worry about is 18. As everybody's now feeling guilty and saying, no, Michael never told me about this. Michael and Doug never mentioned it. It's not applicable this year. Okay. This is it. The accounting update for June 25 are those 3 updates. And the third one, and we'll go through it, the third one, I don't know whether anybody in here has got a sale and lease back these days. Overall, sale and lease back are very, very complicated. They're still very complicated, but this changes the complication of accounting for sale and lease backs. I doubt whether anybody in this room's got supplier finance arrangements. Supplier finance arrangements are very good to have, but are only available to the real big balance sheets. So the fun one is current versus non-current classification. And they very much simplified it. Current versus non-current, the Centro case, people failed to disclose they've got current liabilities, all the scariness of showing current liabilities. They've simplified it. Does the covenant contain conditions that the entity must comply with before the reporting date, before the 30th of June? Yes, no. No? You must comply with it. The condition relates to the 1st of July, the condition relates to the 31st of July, again. It's non-current. If you've got a condition that you must have complied with a banking covenant as at the 30th of June, that's what you need to focus on. Did you comply with it? Yes, no. Gives current versus non-current. And going through, trying to go through it on this slide. The assessment date, they'll get round to testing you on the 31st of August. But on the 31st of August, they test your current ratio as it was at the 30th of June. You fail the current ratio as of the 30th of June, even though it's going to be assessed on the 31st of August. It's a current liability. Move on. You are going to fail. You have a condition that is your ratio as at the 31st of July. As at the 30th of June, you know you're going to fail it. It's still non-current because the condition they're measuring is at after the 30th of June. And same thing, 30th of September, you know you're going to fail it. It's still non-current. Other thing that's changed, old 101 was, it was a current liability if you didn't have the contractual right to delay payment for 12 months, or you intended to repay it. Do you intend to repay that loan in the next 12 months? Are you refinancing that loan? New clarification, don't care what you're going to do with it. It's purely contractual. Have you got the contractual obligation to avoid having to repay it? Therefore, it's non-current. This is a very confusing date slide that I corrected last night, but didn't correct it on these slides. So imagine we're working on the 30th of June, but the 31st of December, you have a loan that you can defer for the next 3 years, but you intend to repay it on the 15th of February. You start the accounts off on the 31st of March, you repaid it on the 15th of February, your auditor knows you repaid it. It is still a non-current liability. Very likely the disclosure is a subsequent event. Subsequent events, we repaid the X loan and refinanced it with Y. But this makes it a lot simpler. Okay. Where it gets more interesting, and I sit there and think, I haven't had enough questions on current versus non-current on convertible notes. I get lots of questions about how do you account for convertible notes, but never, I don't recall many questions on, is that convertible note a current or non-current liability? And if I was being realistic, I do think people have been getting this wrong. You have a convertible note that is mandatorily convertible in 3 years' time. Okay? So lots of people have suddenly think, well, that's non-current. But when you read the terms, it's very likely convertible at the holder's option any time up to 3 years. That's the nature of a convertible note. So when you go into current versus non-current, have you got an obligation to say, no, I'm not going to give you the shares? And you haven't, you know that. And you actually want the holder to convert it into shares. So the new clarification is, if it's only you, if it's you, the issuer, that can force conversion, well, that's not a liability. But if the holder can force conversion any time up to the maturity, any time within the next 3 years, and it's a variable number of shares. In my world, all the discussions I have with you guys about derivative liabilities and fails to fix for fixed, if the convertible note has a liability component, guess what? You've suddenly got a current liability on your balance sheet. So I'm very interested to see, as I go and click accounts again and read combatants and all the questions people have asked me on convertible notes, embedded derivatives, whether or not we've been getting current versus non-current wrong. Got no idea what's this. Okay. Entity Z has issued a convertible note. The note is repayable in cash in 5 years' time. At any time prior to maturity, the holder can elect to convert the note into shares. That is everyone, or 90% of all our convertible notes. The number of shares that become notes into dependent on the share price. I don't know how many shares this will convert into because it's based on a VWAP or a discount to VWAP are all like 90% of our convertible notes. Is the note current or non-current? Conversion can occur anytime in the next 12 months. I cannot refuse to give you a variable number of shares. That is a current liability, which I find interesting because it's always been a current liability, but I'm interested to see how many accounts have got it. A reminder for everyone, everybody looks at a convertible note and says, that's a compound financial instrument. That contains a debt component and an equity component. In real life, 90% of them fail the fix for fix. They issue a variable number of shares. They're linked into foreign currency. There's a cap or a floor on how many shares you get. They're typically linked to a VWAP type arrangement. They're liabilities. Okay. This, again, so taken away, not much has happened. Can you please go and have a look at your balance sheets? Can you please go and have a look at your convertible notes? Can you please determine whether you got current versus non-current right last year? Okay. Banking covenants. Nasty things, banking covenants. That is the why Arian went bust. That is the why Slater and Gordon went bust. Banking covenants are tricky and complicated and various ratios and all sorts of things. We're used to arguing. I don't do audits anymore, so I can say we are used to arguing with auditors. So I quite enjoy my new life. So we argue with auditors. We have passed our banking covenant. Look at it. We've passed our banking covenant. It's non-current. I'm happy. We've relaxed it. You saw that nice bit that, you know, it's we're actually going to have far more non-current liabilities because it's very black and white on that when and if you pass the test. The sting in the tail. Disclosure. I want you to disclose all your problems, all of your worries about banking covenants. If you've got banking covenants that you must satisfy in the next 12 months, else you'll have to repay it within the next 12 months. You've got to tell everybody. And more interestingly, you've got to tell me what they are. You've got to tell me the ratios, the profit, the details of these covenants. And then you've got to tell me, are you going to satisfy them? I'll let you call them non-current, even, you know, you're going to be tested on the 7th of July, or you're going to be tested on the 1st of August, you know, the day after we've signed the accounts. And you're going to fail. Or you know your profit forecast, you know, for that second quarter, it's not looking good that you're going to meet those ratios. You need to disclose it. For me, who's a very educated user of financial accounts, you go bust, you breach your covenants 12 months after the date of the audit report, and you didn't tell me that you've got these nasty covenants that you might not meet. I think I've been misled as a very educated user of financial statements. So take it away from the preparers. You've got to really look at those banking covenants. For the auditors, if I was an auditor these days, the interesting change that's happened this season is that slide. And again, wonderfully, we're doing this on the 27th of May. For the preparers and auditors in the room, please do not have this discussion on the 27th of September. This is something everybody needs to be on top of.
You used quite a positive statement there that we will not meet the covenant. Obviously, forecast has any kind of uncertainty.
This is it. So it's difficulty complying with. Right. It's difficulty complying with. So, well, but you can't, you know, if sales go up by this, and if we do this, and if we manage to negotiate and we're confident the bank will see through it, or that's fine. You just tell the truth. The truth. And then wait for the analysts. And it's a weird one because I could ask a completely sad question to everybody in the room, including myself. Does anybody read the accounts? Does anybody read or use the accounts? But on the hypothetical idea they do, and if Hot Copper picks them up or what, well, they've announced that they're concerned they're going to meet that whether they'll meet that banking covenant in the second quarter. Let's all watch for that. How many suppliers going to feel when they know that you might breach your banking covenants? All the construction companies out there at the moment that seem to be going down like nervous and like. Your supplier to those companies, you're going to do it?
It can be a very self-fulfilling prophecy at that point that, you know, you disclose you 20% above your covenants and everyone thinks you're a bit shaky. And, you know, then the analysts get a hold of it and, you know, word gets around, all of a sudden everyone's saying that company's going.
Oh, yeah. I was doing some stuff because I train a lot of auditors. Going concern. You must, 101 says you must disclose the material uncertainties. And then everybody reads your material uncertainties. And you think, well, I don't want to work there. Right, I'm the project, I'm the technical, I'm an accounting partner. Right, and I'm working for a firm that's got material uncertainties as to whether we're going to meet the banking covenants. By the way, I've worked in that firm, and we didn't. You will leave. By the way, this company might go bust. Well, you know, the chances of me awarding you that contract to build a hospital somewhere, say, you're not going to win that contract. My suppliers, looking a bit dodgy. I'll shorten their credit terms. Going concern, horribly, and this just adds to the woe of going concern, can be a self-fulfilling prophecy. But 101 says you disclose it. 570 says you audit it. And if anything goes wrong, I've got one set. I look at bad accounts. I've got one set of accounts where it's signed off on the 30th of September. And this is a big audit. It's quite a big audit. It was signed off on the 3rd of September. The bank pulled the plug on the 5th of October. You look at that, that's. And they prepared it on a going concern basis. Interesting set of accounts.
They have an emphasis on that.
They felt, but yeah, but okay. So thinking on to going concern, there is only it's only an uncertainty if there is a realistic alternative to going bust. You prepare your accounts on a going concern basis if there is a realistic alternative to going to liquidation or ceasing trading. Okay, as you sign the accounts on the 30th of September and the bank is annoyed and the bank has sent you all these final demands and you're negotiating with the bank, is it realistic the Tooth Fairy or Father Christmas is going to refinance you in 5 days? It has to be a realist. All your uncertainties that you disclose have to be realistic. They'll come off. Not certain. That's the clues in the word. It's uncertain. But I am going to continue as a going concern if the Tooth Fairy comes in and gives me. We are going to continue as a going concern if we win lotto in the next 3 months. You disclose that's the only way that you're going to continue as a going concern is win lotto. Go back to you're not a going concern. Okay, supplier finance. This is Carillion, which is the wonderful big sort of construction company, etc., that went bust in the UK. So Carillion, a big company, uses their balance sheet so I need to pay my suppliers. If I pay my suppliers in 10 days, my suppliers love me. And my suppliers will give me prompt payment discounts. And the big boys, Carillion being the abuser of the system, this is how you do it. And all of our big construction companies will do it. They'll say, all of our stuff is, I will pay you on 10 days. But I want to be loved because I'm paying you so promptly. I want the prompt payment discounts. I haven't really got the money to pay you in 10 days, by the way. So I actually go and get a finance provider. It's reverse factoring, right? So a big finance bank pays my suppliers in 10 days. I owe the financier. And then it goes, there's all sorts of confusion about who do I owe. There's a big difference when you do your going back to going concern. I owe my suppliers. Everybody's relaxed. I owe this big nasty financier. People get a bit upset. So how people were dealing with this, I've never paid the supplier. So I'm actually showing it still as a liability. I'm still showing it in trade creditors. In my cash flow statement, I haven't got any of that borrowing stuff coming in because the cash never came into me, if you imagine. The borrowings went straight to my supplier. So when I'm doing my cash flow statement, I'm saying I paid the supplier. My cash flow statement doesn't mention that I've got this really clever little deal going. Carillion went bust because the financier refused to keep going. The financier lost confidence. And then suddenly Carillion couldn't pay their suppliers. And their suppliers are happy there that they get paid on 8 days, 10 days, and have got all that discount. Suddenly the financier in Carillion says, well, I'm not doing that anymore. And Carillion went bust because suddenly it couldn't pay suppliers on 8 days, 10 days. And then the suppliers refused to supply them, and the whole thing collapsed. And everybody has sat there and said, me included, you read Carillion's accounts, You can't see it. Nobody, you know, it's obvious the key thing to going concern and the key everything was this supplier finance. And we all sat there and said, well, that's interesting. No idea what to do with supplier finance, what's wrong with the cash flow statement, what's wrong with the balance sheet. The solution, the change, disclose everything that's happening. Tell me, if you're using supplier finance, how much do you owe the financiers? And how have you shown it? Do you show that just as trade creditors? And if you do show it as trade creditors, tell me how much of that is really to the financier. And what's the payment dates on it? And how does it all work? So there's a lot of disclosure that's going to be out there, and it's all the fault of Carillion.
What about the cash flow statement?
Just notes to it, notes to it.
So it's still payments to suppliers?
Yeah. But of the payments to suppliers, this was done as a note. This amount was done via reverse factoring. And it's really right, because, by the way, I wish I could do reverse factoring as well. It's a really, really good business model. It's not something that's wrong or bad practice. It's only bad practice if suddenly you can't do supplier financing. And that was the problem with it, you know. Everybody looked, Carillion died, nobody saw how bad Carillion was. And we, the accounting standards, didn't warn us of it. So they've closed the stable door after Carillion bolted. The next change, I say, which is very, very interesting, very complicated, and if you've got one of these, please phone us. Conceptually, when you derecognising a lease, a sale and lease back, is actually very difficult to recognise the building itself, because it's tied into the concept of AASB 15. You can recognise a sale, and you know the clues in this is a sale and lease back. You only can recognise a sale if you lose control of the asset. You know, that's the basic principle in 15. Well, you know, in a sale and lease back, it was your building, you're still in it. Have you really lost control of that building? It's really difficult to actually even get the accounting there. And then you get peculiar things that if you have and manage to structure it, if you have variable lease payments, you don't recognise a lease liability for something that's got a variable lease payment. So the whole problem is, how the hell do we do this? I don't understand the debits, credits. I actually don't want you to recognise any profit. It's so unlikely you will recognise any profit on a sale and lease back. But all of this is to explain with more clarity. Don't recognise any profit, and don't do a sale and lease back, or do a sale and lease back for cash flow purposes. Don't do a sale and lease back for an accounting profit benefit. Okay, and I can tell you this: all those people that were suddenly worried about IFRS 18 and why hadn't I told them about that for this year's accounts. IFRS 18. I could actually say this in my lifetime, in my professional lifetime. This could be the last big standard. This could be the last big standard, and it's going to be confusing.
But you're not talking about sustainability.
this is a financial reporting standard. I could actually be very flippant. I'll come to a very squirrel side. I'm convinced that very likely will be no new big sustainability standards in my professional career. I could say for the next 15 years, I think we'll actually be struggling on what the hell S2 means. That does not mean sustainability is here, S2 is here. There are so many holes and problems with S2, it's going to take us 10, 15 years to work it out. And I actually struggle that anybody's going to extend it. There's all this dream that we're going to have climate, S2 is only climate. There's this dream we're going to have nature, we're going to have culture, we're going to have modern slavery, or all sorts of things that flow from it, the full ESG. Did I mention we've run out of money? That even if there was a desire for those new standards, there's no money. There's actually no money to write them. Okay. The thing to watch and to prepare for. So for all those people that plan. So 101, the way we see the P&L, the way we see the balance sheets at the moment, that's been scrapped and it's been replaced by IFRS 18. It comes in beginning or after the 1st of January 27. So anybody on a December year end, it is December 27. And you're sitting there thinking, thank God for that. It's May 25. I really don't have to worry about that. But it impacts the half years for June 27, which is actually only 2 years away. And by the way, you need comparatives. So it turns it into a year away. So arguably, you've got 12 months, which is live because you obviously you won't do it. All the things I said about 15, you've got 12 months to get ready for this. And this is rhetorical. How many people will just only worry about that until December, maybe November 27?
I mean, there are December year end.
No. You know, but so this is happening. We all in the next year, 2 years, need to get on top of 18. And the highlighted thing is it's turning the P&L into the same format as the cash flow statement. Is its big headline. So we need clearly the P&L to be split up between operating, finance, investing and financing. And interestingly, that investing thing includes profits from JVs and associates. And I'm not quite sure when I jiggle that new formatted P&L, where does EBITDA happen in there? How exactly can I do, what ratio now am I going to be showing and concocting to show my sustainable EBITDA, my whatever? But that's what we're going to aim at. All your chart of accounts, all your consolidations, we were moving to this brave new world. The world wants to see operating profit. And it wants to see profit before financing and income taxes, which is a sort of EBITDA, but it's really difficult to get the da and the a in it. And the key concept, more structured income statements, it looks like the cash flow statement. Operating, investing, financing. Everybody's worried and concerned and have discussed MPMs, the new jargon for our world. This is your management performance metrics. So you know in the front of your reports, in your analyst brochures, it's sustainable EBITDA, it's cash EBITDA, it's EBITDA before debits, or however your CEO, your chairman, your public relations guys decide to show your performance. They've actually decided we can't define it. We've given up defining it. We've given up trying to stop you doing it. So now we're going to make you disclose it, explain it, and have it audited. And we want far greater disaggregation. I can't see what's in other creditors. I can't see what's on other income. I can't see that big black hole of potentially interesting things. So 18 says I want it. Operating, investing and financing. The one I'm very interested in is associates and JVs and these assets that just generate cash. You sell shares, you have a one-off thing in selling investments, and that's nothing to do with your operations. Show it me separately. If your business is lending money, that's an operating activity. If your business is investing and getting returns, that's an operating activity. There's going to be, for things like BMW or Caterpillar, there's a massive debate about what is their business. Do they sell cars? Sorry, do they make and sell cars? Do they make and sell big yellow things? Or do they actually lend people money to buy cars? So there's certain big operations, BMW, Caterpillar, there's going to be a big debate of what is your business? And where do you put it into the, what's your operating activities and what's your investing activities? Okay. Relatively old style, sorry, that's current 101. Profit before income tax, 625, that's good, isn't it? Profit for the year, profit after tax, 425. Revenue, 500,000, finance income, we're doing quite well there. Income from JVs, gain from disposal or investment. The board are pleased to announce we made a before profit tax of 625,000. I turn it into IFRS 18. They made an operating loss. They only showed a good performance because they're selling the family silver. They're selling assets off to maintain EPS. This conception is why people believe, or why the theorists believe, this is a more useful way to present your income statement. Okay, management performance measures. And this is again looking A for the financial controllers and B the auditors. This is anything in a public document. Not the financial report, not the director's report. Any analyst briefing, any PowerPoint slide of figures, any briefing anywhere that you've had non-recurring this, free cash EBITDA, the sustainable EBITDA, recurring EBITDA, whatever. Challenge for the financial controllers, do you know how many different ways your CEO or chairman presents your profit in a year? Question for the auditors, how are you going to do that?
Sorry, is this the face of the thing I'm talking about?
No. This is within the notes. There's going to be a whole section that people like me are going to read. First time it comes out, I am just going to be reading those notes like you can't believe. And so are the analysts. And
so like all-in sustaining costs for a mining company.
Yeah. All right. So question. If a junior explorer never, because it's never publicly, never mentions in presentations their loss, all they do is mention is how much cash they got left to waste, and all their drilling results and photos of rocks, and tables are full of drilling results for job purposes. The only performance measure is getting a job report or things which ASX let them put in ASX announcements about their results, or how much cash they got left to burn. Cash flow is critical for seeing how well they run out of cash, but I don't mention that publicly.
I would actually, I'd love to see the disclosure. And by the way, it's fun because it's going to be, you disclose, we have no performance measures. Which is going to be very honest for a junior explorer. But that's just going to read so interesting, which is very true. But yeah, for a junior, it should be that statement. You know, we're not focused on profit, but brackets, we don't make any profit. Yeah. But for everybody,
I'm assuming it's just where you've got remuneration linked to
no,
just any sort of
anything.
Yeah.
We are pleased to announce the first quarter has shown a 20% improvement on free cash EBITDA. And then next year, we're very pleased to announce that it's a 5% improvement on sustainable EBITDA. And I'm just quoting Doug Niven on this because I listen to him so many times. His problem with performance measures, they keep on changing. He could actually live with somebody, they always get measured on cash, or they always get measured on EBITDA, or but they do have a habit of changing, normally to show a 5% increase on the previous period. And you can actually check, when we think of it cynical, I can see them change quarter to quarter. This is why you need to do it.
But by virtue of every exploration company, as Paul's touching on, you have to do quarterly cash flows, right?
Yeah. But you're not going. You're not going out. You're not going out there. You know, the number of reports. Now, remember, I've got a very tainted view of the world. If I'm looking at a financial report in detail, there's a really high probability something's gone wrong. The nature of some of the expert work I do. So I list, and I know it's gone bust. I know it went bust, say, 5 days after they signed the audit report. It's my classic one at the moment. But then you think, well, I'll read all the announcements. I'll read the director's report. We are happy in this, we're making progress on this, and we've done this, and we're recovering this, and we're confident of this, and this is showing this. I've got numbers, and I actually know the ending of it. This is the Titanic, it sank. But I'm reading the front of it, we're going on a wonderful cruise around the Caribbean. It sank.
Follow-up question. Because junior explorers, item 7 of a quarterly cash flow reports how many quarters of cash burn they've got left based on operating activities plus exploration costs capitalised. Can't you just use that cash burn rate used in item 7 of cash flow statements as your reported management final measure, because ASX tells junior explorers to do so?
I would imagine so. Okay. Explain why management use that MPH. That'd be good speaking to your CEO and your chairman. How they calculate it when they put it out there. Reconcile it to the accounts. And don't audit it. Impacts. Operating profit struggle, losing the benefit of really in the mining sector. We operate a lot of JVs and associates. That's not in your operating results anymore. Okay. This is looking ahead to January. Technical things coming through. But I want to share this because myself and Susan chatting about this before. Do you realise we've all been getting bank reconciliations wrong forever? I've suddenly realised, having been looking at bank reconciliations, the first thing I ever did as a grad back in 1989 was do a bank reconciliation, unpresented checks, late lodgements. You realise it's wrong. I have written a cheque and I've kept it in my drawer. Do I still owe the creditor? And if my desk burns down, do I still owe the creditor? Because I've kept it. If I put the cheque, don't you worry, in the old speak, my speak, the cheque's in the post, right? And the post gets eaten, lost, delayed. Do I still owe the creditor? Don't you worry, I'm sure I put it in the post. I'm not paying you that $10,000. There's the cheque stub. I diligently write my cheque stub and I recorded it in my cash book. I don't owe you $10,000. And I know we've got a few lawyers in the room. They go, so is that okay? Or do I owe them $10,000? My chances of going, no, look, here's the cheque stub, I'm very sorry. The logic that we finally realised in these amendments, unpresented cheques should not get deducted from cash. And you should still show a liability owing to trade creditors. You think, why have I been getting it wrong for 32 years? Okay. You know, as at the midnight 30th of June, there's a cheque in the post coming to you. And the cheque arrives at your office, and when you open the mail, the cheque arrives on the 2nd of July. And the cheque is dated 28th of June. And you go and the auditors go and check the postmark was the 28th of June. That'd be one of those unpresented cheques. Can I, as at the 30th of June, midnight on the 30th of June, can I spend that unpresented cheque? Do I control it? Now, I only recognise an asset, like if it's cash, and I control that asset. Why would I treat the cheque in the postal system as at midnight on the 30th of June that doesn't turn up until the 2nd of July? Why do I treat that as cash? And the answer is you can't. But he's taken this amendment that comes into play from the 1st of January 26 to tell me I've been doing bank recs wrong for the last 32 years. The interesting thing, the real amendment is everybody's. So what, the technical argument is, when is a liability extinguished? And the answer is, a liability is extinguished when the creditor's got the cash. Relatively reasonable, but that's not the way we get done it. Then there was a massive debate. I actually don't, so all the old people, I do remember doing math recs, and I do remember check stubs and all the checking postmarks and good old auditing. We live in a world of direct debit. And I run a check payment, I run a direct debit payment on the 29th of June or on the 30th of June. How do I account for that? When does the cash actually hit my supplier's bank account? The answer is, I don't really know. I can suspect it might take 2 days, depending on which bank's talking to which bank and which clearing system and whatever. The special exemption is if you've got no way of stopping it. For this reporting season and for all reporting periods coming. He looks at the profit. How do you get to that profit? You get to it by material items of income expenses. You get to it by material non-cash items. So the way this interpretation goes, you need to significantly, if the segment's profit, if the segment's EBITDA has been impacted by these big one-off items, not some of them are non-cash, write down the inventory, disposal of PPE, disposal of investments. I, as an interested user, would like to see that in your segment note. And it could well be, so that could well be a change from past practice and something that should be again pondered before the 30th of June, or certainly in the first couple of weeks in July, and not argued with the auditor by the last week in September when somebody's finally checking the segment note that's not been filled in until the last version of the accounts that you give the auditor. Have many of you been following the MinRes debacle? It's an interesting tale. And I would suggest for the preparers in the room and the auditors, related party transactions could get a bit more interesting this year. Related party transactions for the preparers, it's all under AASB 124. For the auditors, standard possibly, we need to dust off quite a lot. It's 8550. And a reminder for everybody, there is no materiality on related party transactions. I, as a user, are very interested in all related party transactions, I make financial decisions about how company interacts on related party transactions. It is material. 124, you need to disclose all transactions. The auditors, you need to ensure you've got sufficient appropriate audit evidence to determine all related party transactions are being disclosed. And then you need to determine, so you need to disclose the terms on which those related party transactions occur. Was it on normal commercial terms or was it at mates rates? And we'd be, as a shareholder, I'm really interested in the mates rates terms. If people that have not been following, and this is just a hypothetical worked example of how you could, if you were a very dominant CEO, in potential cahoots with weak but compliant fellow board members, come up with some quite tax efficient things. You are buying interesting gear from China, cheap, and you set up a BVI company to buy the gear from China, and you sell it to your Australian business in West Perth for quite a margin, creating quite a lot of profit in the BVI. You might then think, well, how do I get out the cash from the BVI? Tip, you set up a company credit card in the BVI company, and you use that credit card to pay your school fees, all the things that go on in Perth. Any of you that are planning to do any renovations, particularly on your luxury island in your mansion, you obviously need earth moving equipment and big gear to build that house. There's some really cheap second-hand gear that you can buy from your company. So let's get the gear. Now this is yellow stuff, but it could be computers, screens, second-hand Land Cruisers, whatever you feel like, whatever's lying around, particularly some of these junior explorers. Fuel. You have one of those big guzzly yachts to get over to Rotta. Well, you know, even if you're an explorer, you've got a fuel card. So what stops you pulling the fuel card and using and filling up your yacht? You've got guests coming round. You've got a 21st birthday party. You need people to help out at the party. You give out the champagne and the. Well, I've got people on my payroll. I've got casual labour that are on my payroll. There's an efficient way of getting that party staffed, and my daughter's 21st will go off my farm, or my 25th wedding anniversary. Daughter's just set up an art gallery. I'm not convinced it's actually going to make that much money, but I've got this nice sort of old warehouse sitting somewhere by the water. Let's give her free rent in that property. They, by the way, are all related party transactions. They are all related party transactions that need to be disclosed under 124. They are all related party transactions that need to be audited under 550. The signing audit partner needs to get sufficient appropriate audit evidence that those have been identified and recorded and disclosed. I would suggest to everybody, but auditors particularly, and I know, what controls has the company got in place to identify all related party transactions? Has the company got a code of conduct that says you can't do it, or if there is any related party transaction, it has to be disclosed. Who approves related party transactions? Who approves the CEO's expense claim? Have you got policies that if somebody was using the company fuel card, if somebody was diverting employees, if you're disposing of old gear, have you got policies and procedures that would pick those transactions up? Because I would suggest in June 25, people need to dust off those policies, get those policies in place, or you may, interestingly, get a qualified audit opinion. Because the auditors now, 422 must be feeling quite uncomfortable with this. The auditors now must be, I'm not going to let that happen to me. And they should be asking, because 315 requires them to do, 260, 265 requires them to do, what policies and procedures have you got in place? Interesting times. Section break, we had that. Okay. Economic update. I don't know. I really don't know. I heard there's two phrases that are going out on social media, go out on LinkedIn. I think at the moment, I am an abuser. Anything but the United States of America. So you've got problems, people are moving away from the States, looking for not doing deals with the States. I'm equally, and another one, Donald Trump. Donald Trump is Taco Bell. He always goes chicken. So all this, I don't know. There was a whole slide pack I had prepared, tariffs. Tariffs were, I thought, an impairment indicator. I think the uncertainty on tariffs are an impairment indicator under 36. But I don't know whether you can sort of reverse impairment indicators. He said he was going to tariff us all on this, but now he's changed his mind and he's not going to do it maybe until 60 days, 90 days, which is actually after the 30th of June. So we live in this amazing world of tariffs. Is it an impairment indicator? Should you be factoring into your future cash flows and your risk rate in your future cash flows? We all sit there not quite knowing what's going to happen. Whether our suppliers are going to go bust, whether transport things are going to go weird because boats are travelling around empty and are in the wrong place. Whether we're going to be able to get the gear from the States. Where are you doing that? Where are you putting that in your risk when you're doing your cash flow models, when you're doing your impairment reviews? All of us, the preparers under AASB 110, the auditors under ASIC 560, watch this space. Depending on what he's done, what Mr. Trump has done between the 3rd and the 30th of September, could well require disclosure as a subsequent event. And is it impacting anybody's going concern? If you can't get the gear from China, if you can't, because they've closed down, you know, this isn't the, you can't sit there and say, I don't sell anything to the United States. But what happens if your key Chinese supplier has got 50% of their business going into the States? and your key supplier, your whatever is supplied, whatever widget comes from China, and your supplier goes bust. So interesting times. Forecasts, discount rate, cost to complete. How much? Where do we get our stuff from? Is all this going to get more expensive? Economic update. We live in interesting times. Inflation's down, the headline, but wage inflation is up. And inflation is just a vector. Everything is more expensive. Everything in terms of wages, materials, fuel, transport is expensive at the moment. Our companies are able to pass that on to their customers. Are customers getting nervous because of Trump? Are people not going to buy that, not going to spend that, not going to do that? Does it affect it? Inflation rate, it's coming down, but we've still got that wave that we've experienced. You go and buy anything from the supermarket, you go and buy any piece of equipment, it's a lot more expensive than it used to be. The exchange, the bill rate, it's still high. You know, they're coming down in bits. Everybody, the economy is a weird lag on it. A lot of people, including mortgages, including borrowing, you're on a fixed term, you're on a fixed rate. So a lot of people don't get hit by a rate rise immediately. They get hit by when the term comes for renewal. And actually the pain caused by interest rates is higher now than it was when the interest rates were at that peak. Aussie dollar, not looking too good. And for those of us that like skiing in Japan, the yen is strengthening all the time, which is really unfortunate for everybody. I can't afford to go to the States, and the euro is appreciating as well. Anybody importing from those countries, your cost to complete estimates, your ability to pass that on to the Australian consumer is struggling. Latest ASIC bankruptcy. We're having a lot of bankruptcies. Construction. Anybody in the construction area, anybody supplying into the construction business, interesting times. Food and accommodation services equally is getting hit by that downturn in consumer spending. By the way, lithium's still bad. And if you want to know about lithium, nickel is not doing, the only place to be is gold. Worryingly for us all, somehow lost the slide, I prepared the slide and lost it. Iron ore, all this Trumpism. Guess which commodity it hits? Or it's how gold, you can't believe how good gold is. It hits iron ore. And iron ore's coming off. And the impact on the Western Australian economy when iron ore's down is unpleasant. And, you know, I'm doing this presentation 27th of May. A lot of you will have your account signed off by the 27th of September. Lots of things could happen by the 27th of September, and people need to be aware. Subsequent events, going concern. It's going to be an interesting ride. I can't predict where we'll be by the 27th of September, but I'm obsessed with listening to news, podcasts, etc. They now sort of hourly stamp them. I am presenting this on Wednesday at 5 o'clock because by the time I've finished putting this presentation together, everything I said could be wrong. So it's a really weird thing of putting this economic update together. Just there's Trump. Accounting consequences. Cost to complete. Estimating cost to complete. I'm not sure. Can you get your supplies? Are those supplies going to be more expensive? Are the supplies going to be delayed? And if you're delayed on a construction contract, are you going to incur penalties because you're delayed? Which one of these weird things that are going on is an impairment trigger? External, internal triggers on impairment. How are you measuring fair value? What is the discount rate? What's the condition we are living in at the moment? Credit losses. Remember, credit losses are looking at the future. Credit losses are looking at segmenting. Do you supply to the construction industry? Which of your trade receivables are going to be impacted by this weirdness? And is the economic outlook worse now than when you lent to them or gave them credit? Going concern, going concern, going concern, linking with subsequent events. Okay. This annoys me because I need to update the slide. By the way, if you go to the ASIC website, these are their enduring focus areas. That's a fact. When you go and read ASIC's latest updates on last week, we would like to go through, we are still focusing on our enduring focus areas, and it starts with revenue recognition. So this is the enduring focus areas per ASIC website, but it's got revenue recognition. They sort of forgot to put on their website. Bless them. They are obsessed with goodwill impairment. They are obsessed with triggers. They think people are missing triggers and not testing assets for impairment because there's been a trigger. They are very upset about assumptions, reasonableness of assumptions. Even for certainly the lower caps, they have absolutely determined that saying the recoverable amount of my asset is fine because my market cap is above the carrying value of my asset, which to me is actually a very sensible way of doing things, particularly if you're a single asset business. ASIC say, no, that doesn't work. That's not sufficient. It's a good sanity check, but it's not the primary check. And they're absolutely obsessed with saying, and by the way, if your market cap is below the carrying value, you're in trouble. Disclosure about any recoverable amount. And if you say, we have determined the recoverable amount is fine because of our market cap is this, they're going to come and visit you. Asset values, they're convinced that commercial property, retail property is weak. They're convinced that people aren't updating their valuations for the current market. So ASIC are interested in you. They have worked out, AASB 9 is interesting, expected credit losses, the crystal ball of what's changed, the crystal ball of what has changed, what is going from stage 1 to stage 2 to stage 3. People that are not having provisions against major receivables, are not disclosing the key assumptions on it, are going to have an ASIC, please explain, visit. The world has changed. So just because you've had a history of this is bad debts, I've only had a 2% bad debt rate, etc. That's no defence in the world of AASB 9. We've got the change in the economy, unique economy this year compared with what it was last year. Therefore, tell me your prediction as to credit losses. They believe people are getting classification wrong. You can only classify financial assets at amortized cost. The business model is hold to collect. And the interest you get is solely for the purpose of principal and interest, SPPI. This is ASIC are interested in it. They are convinced people are recording things at amortized cost that should be recorded at the fair value. ASIC are upset about NRV inventories, recognising deferred tax. They are amazingly focused at the moment of any unlisted investments. Provisions on their focus areas, provisions, onerous contracts, mine site restoration, financial guarantees. That's the areas they're looking at. Are people dealing with subsequent events and relating subsequent events into how the estimates people made when they created their June financials? Focus area is disclosure. They want the disclosures to relate to the entity. They want it to be specific entity. They don't just want it copy and pasted out of XYZ. They don't want it copied and pasted out of some other company that you used to work for. They don't actually want the same disclosures in the 4 sets of financial accounts that you prepare. Uncertainties. What's changed? What are your key estimates? What are your key judgments? What's the uncertainties about your recoverable amount? What's the uncertainties about your predictions on ECLs? OFR, which obviously, for me, for the auditors, we're not really that bothered about the OFR. ASIC are obsessed with what goes in the OFR. They raise more queries and concerns on the OFR than they do the financial statements. Arguably, it's a lot easier to criticise an OFR. You don't need to understand accounting standards to be able to raise 30 points on why did you disclose that. Non-financial information should not be presented in a potentially misleading manner. Okay. They are upping their review. Risk-based, market capitalisation, current market and accounting disclosure, ASIC intelligence, external reports of misconduct. And they have made, and very proud to say, they're making companies restate their accounts. One of the things I'm not going to have time to put up on here, they used to do name and shame. There used to be media releases. ASIC are very pleased to announce XYZ. Company Limited has messed this up. And there's a weirder one, and I need to go and actually get time and read it. In their surveillance report that they issued in October, they say, we issued these media releases, that company messed up, that company messed up, that company messed up. And then they said, and in addition to those, there's about 15 other companies listed that messed up, but we haven't issued a media release. And now for somebody with my curiosity, I need to go back and read and understand what they messed up and who the auditors were. But there were some big companies on that list. And there's quite a few Western Australian companies on that list. Okay. The financial reporting surveillance, this is they pick a selection of the preparer's accounts. And this is what they're worried about. I say OFR is the main one. Then we've got impairment, revenue recognition, share-based payments. I've had a lot of companies, my clients, getting quite interesting, please explain letters on how have you done your share option accounting? How have you done graded vesting? And asking very, very good, very reasonable and quite difficult questions about how have you applied AASB 2? What's the estimates in valuing the option, and how are you actually recognizing what's the vesting period and how are you recognizing that expense? The revenue recognition is there. There's the, sorry. Classification, current versus non-current, failure to recognize impairment losses, revenue recognition. They actually picked up one, which is about time, agent versus principal, which is really, from my world, is quite interesting and confusing. The number of companies that very likely misstate their accounts because they're not actually the principal. When you look at restatements in the US, a lot of restatements are agent versus principal. Now ASIC seem to have caught up with it. When you're looking at industries they're reviewing at and the number they're reviewing, they're getting interesting. They're expanding their surveillance. They're going to look at large PTYs that were previously grandfathered and never prepared, general purpose or consolidated accounts. They're going to look at registered superannuation funds. They are looking in quite detail on auditor independence, auditor rotation. They have got the auditors, the disciplinary board is active again, quite active, and they're taking auditors to court. They're getting scalps that the auditors breached the Corporations Act, not just taking a suspension. Okay, it happened. That should have. Did we see the election? Anybody see the election? If you'd have asked me where sustainability reporting was going to go, if you'd have asked me the conversation in January, it's not going to happen. Trump's come in the US and drill, baby, drill, or whatever the phrase is. The EU has just scared themselves to death that the sustainability, the EU reporting is too complicated, and they came up with it. Brilliant, this is amazing. And now the EU has said, no. If you were betting in January, it would be, this isn't going to happen. Did we see the election? Did we see that Greens have got the balance of power in the Senate? This is going to happen. And we actually don't know how to do it. The ability to audit it, because it has to be the same auditor as your financial report, has to do it. Those are the deadlines. Those are the criteria. So the group 2s, the group 3s, and there will be people in this room that are group 2s, group 3s. Sustainability, not financial reporting, but sustainability reporting, which has to be audited by your financial audit. And I'm not sure which one in your organizations are going to have to prepare that sustainability report. I'd imagine it's going to fall on the accountant. This is our world. You can't believe how many times I've read S2 at the moment. And you can't believe I'm reading 5,000 and getting more confused that when I read the assurance standard on 5,000. This is the big thing for the next 3 years, because it's not going to go away. the election means this can't go away. We will be the most regulated, disclosed everything in the world, but I just can't see it going away. Proposed good news, or I don't know whether this is good news. Presented last year, the 5th version of the ASIC governance. It was going to do all sorts of things and make more disclosure that people would say they did and then just didn't do it. It was cancelled. So we are sitting there with the 4th edition, keeps on going.